Natural gas futures are trading lower on Thursday following a bearish government storage report, keeping downside pressure firmly intact. The market is now threatening the psychological $3 level. According to the EIA, working gas in storage totaled 3,185 billion cubic feet as of January 9, reflecting a 71 billion cubic feet weekly withdrawal, well below the 5-year average draw of 146 billion cubic feet. Despite the draw, inventories remain 33 billion cubic feet above last year's level and 106 billion cubic feet above the 5-year average, reinforcing the view that supply remains more than adequate. Weather conditions during the sample week were much warmer than normal across most of the U.S., limiting heating demand, while wind generation was only marginally changed. As a result, demand remained muted despite the calendar advancing deeper into winter. Looking ahead, analysts expect moderate demand between January 21 and 29, with frosty air pushing into the Midwest and East. Highs are forecast in the 10s to 40s and lows ranging from the single digits to the 30s, supporting stronger, but not extreme, national demand. Late this weekend into early next week, a more notable cold shot is expected to reach the northern U.S., extending into northern Texas, the south, and southeast, while the west remains mild. However, the language used by weather forecasters suggests this cold is brief in nature, reinforcing the idea that it is a short-lived cold shot rather than a sustained pattern shift. This likely explains the market's limited reaction to the colder outlook. More importantly, storage levels remain too high and are trending in the wrong direction for the bulls, leaving little room for a meaningful rally. Adding to the bearish backdrop, the EIA's latest short-term outlook continues to project weaker prices through the first half of 2026, with a more constructive rebound not expected until next year. Meanwhile, if you have been following my analysis over the past year, you should remember that I kept pointing out that the November and December price surge was largely speculative. Production was steadily increasing and setting new records almost every month, but that inconvenient detail was mostly ignored. Nevertheless, large speculators pushed prices higher in November based on early forecasts for a colder winter, then drove them even higher in early December after just one single week of colder than normal weather. In the end, the warmer winter did what fundamentals usually do. It erased the hype and pulled prices back to a fair value range, right where the rally originally started in October. Once again, reality arrived late and quietly shut the whole thing down. As you can see, natural gas once again lived up to its reputation as a highly speculative asset, driven more by shifting narratives than by fundamentals, which sooner or later step in and force prices back to more realistic levels. Technically, the bulls may attempt to push prices higher if genuinely cold weather arrives in February, but any move is likely to be short-lived. With winter clearly nearing its end, it is evident to everyone that a prolonged, strong cold spell in March is practically impossible. From a technical perspective, the market is now threatening the psychological $3 level. A decisive break below this threshold would likely accelerate selling and expose a multi-month downside target near $2.80. On the upside, initial swing chart resistance is seen at $3.50, followed by $3.60. While short covering could eventually lift prices toward these levels, any rally is likely to encounter heavy resistance. The 50-day moving average at $3.88 remains the first major barrier, followed by the main resistance at $4, which continues to define the longer-term trend. With the trend decisively lower, the market should remain in sell the rally mode until the 50-day moving average is reclaimed with conviction. Please don't forget to comment, watch the previous video, and show some love for the channel. See you next time.